Hmm. Oh, is it time to do another Q&A video? Hey everyone, Ryan here, local mortgage expert, mortgage nerd, at it again, answering your questions about mortgage and real estate financing. I really love doing these videos. I think they're fun. I try not to prep too much. I just try to go right into the question, kind of answer it the best I can. But I really have a lot of fun doing this. I love doing home loans, mortgage loans, been doing it for over 23 years now. Do a lot of real estate investing. I just love real estate and I love doing the financing part of it. So let's just dive in. I like to keep these videos right about 20 minutes or so. So let's see how many we can get to today. The first question is, what are some reasons why lenders might not approve a mortgage? There is a guideline for just about everything. And when there isn't a guideline, it'll always kick you back to some other guideline or some other way to resolve it. Or at very worst, it comes up to underwriter discretion. So if the file is strong enough, if all the other boxes are checked, maybe they can get away with something that isn't. But honestly, there is a guideline for just about everything. So some of the reasons why a lender might not approve the mortgage will almost always come down to credit, income or job, assets or down payment, or property type and use. I would think those are the four of them? Yeah, four biggest categories of why a loan doesn't get approved. And that, now, it doesn't mean that the credit has to be perfect, but there's certain credit minimum scores that if you just don't have it, if you got a 400 credit score, you're just not getting a loan to 100% financing. You know what I mean? So it is something that's one of the biggest reasons why you might not get approved is credit. Then job or income. If you don't make enough income to qualify, you're not going to get approved. If you don't have enough money for the down payment with your credit score and income, you're not going to get approved. And if you use the property as a rental or vacation, or it's a manufactured home, or it's not in good condition, you're not going to get approved for the loan. Even if all the other boxes get checked, if the home is just falling apart, you're not getting approved. So there's really a guideline for everything. And that's why working with a lender, working with your loan officer, going through all the stuff it takes to get a mortgage, hopefully you can find out soon enough or try to fix the things that would cause you not to get approved. Next one I found was a really interesting question. When did the disease of a mortgage loan start in the real estate sector? Now, there's a few people out there that really hate the idea of mortgages. They've ruined home prices. They've jacked up home prices like crazy. And there definitely is some evidence of that. When easy money is available, the system gets abused. It creates artificial values. You see this in some other states where they have limited the type of refinancing you can do, the cash outs you can do, which has kind of kept a cap on home appreciation. It hasn't let it really just go crazy because they limit the type of financing that can be done, or more money has to be put down. But I've been in the mortgage industry, so I'm going to be biased, but more people have gotten into homes that never would have been able to if it wasn't for mortgage and if it wasn't for mortgage insurance. If those two things didn't exist and everybody had to put 20, 30, 40% down, there'd be way less homeowners. And owning a home is part of the American dream. Owning your own place, having your own space, being able to have the pets you want, to be able to remodel the way you want, to have the features, the customization, the appreciation, tax man. There's so many reasons to be a homeowner. And we're one of the few countries that really has prioritized that. And I think it's helped our economies. It's helped stabilize things. They show reports that if you're a homeowner, you're far less likely to miss days of work. If you're a homeowner, you're more tied into the community. There's more of a sense of ownership and pride in the place you're at when you actually own than when you are renting. Now, there's a time and place for renting. Don't get me wrong. Not everybody's going to be a homeowner at 16, 17, 18 years old. You know, there's stages of life where you go through renting smaller apartments and you eventually kind of move up, mature, graduate, whatever you want to call it, to home ownership. But if it wasn't for mortgages and especially mortgage insurance, there'd be far less owners. And I think there's more of a benefit to a mortgage than some disease. So when I saw that, I jumped on a soapbox right away and went, holy cow, I'm not going to be in that camp. I believe there's way more positive that's happened in mortgages than anything negative. Next question. What are the differences between FHA and VA loans? Which one is easier to obtain when having poor or bad credit? FHA and VA are government-backed loans. They actually don't loan the money. They set the guidelines that if lenders follow those guidelines and there's a problem with the loan where it goes into foreclosure or something like that, their insurance or they kick in to cover the losses. Excuse me. But the big difference between FHA and VA, they're very similar on some of their guidelines, VA loans are for veterans only. You can't get a VA loan unless you've served in the armed forces. And there's certain requirements of which branch of the military, how long you've served, if you went into active duty, if you were honorably discharged, disability. There's a lot of different factors, even for the veterans to get the loan. But if you haven't served, you can't get a VA loan at all, no matter how your credit is. So FHA is typically better for people that are starting out with lower down payments, and they do allow a lower credit score than other types of loans. But FHA technically doesn't have a credit score requirement, just lenders have that requirement when dealing with the programs that they're offering. So FHAs are a little bit better on going with the lower credit score. But when anybody asks about how hard it is to obtain a loan or what do I do with bad credit, I always ask, why is it bad? Is it bad because you've missed payments like crazy, like 30, 60, 90-day lates on credit cards? Is it bad because of bankruptcy? Is it bad because of foreclosures? Is it bad because of repossession? So a lot of times there's different levels of bad when it comes to credit. I've seen just awful credit. Then I've seen times where they think it's bad and it's not really all that bad, or it was bad a few years ago and they're kind of recovering, maybe as a bankruptcy, foreclosure, divorce, whatever it was. So there's always different levels of bad. So it's hard to just say, okay, which loan is better or worse for bad credit. It really comes down to why the credit's bad. And if you can work on it, there's little things you can do to help your score to get the better loan. A better credit score gets you a better loan, period. There's not going to be a time where you're going to get a worse loan if you have a 700 score than a 600 score. So you want to work on the credit. Plus, it's a part of learning how it works. It's part of maturing to the point where you can be a homeowner. It's part of knowing how to handle your budgets, know how to control some spending, just kind of be more disciplined, a little more mature to get a higher credit score, because it does take time. That's one of the things a credit score is. It's a credit history, not a credit day or a credit week. So I've had people that have had horrible credit for years. They start to clean up their act and maybe they're clean for 2 months, 3 months, 4 months, whatever it is, and think all the negatives should just be erased. It doesn't work that way. It's still a history, but there's still things you can do to build up the positive while you're reducing the negative. And part of my job is to help people say, okay, here's where you're at today. Let's work on X, Y, and Z over the next couple months. Let's get the score. Let's get the credit. Let's get maybe some debt management, tighten up the belts a little bit, work on a budget, get some things done to make it to where you can qualify for that home or a better home loan. If you can qualify for a better home loan, you're going to get better payment, which then means you can qualify for more home for the same monthly payment. And we all know we need our dollars to stretch as far as possible. So if you can only afford $1,500, $2,000, $2,500 a month, you want to make sure you're getting the best loan possible. So that's also the best loan amount possible. So hopefully that recaps that a little bit. Let's see. What was the next question I saw here? This one I thought was interesting. Would you be able to deduct your mortgage interest if you pay your mortgage with after-tax money? So I look at after-tax money. Isn't that just your net? I mean, maybe somebody can comment below. After tax, isn't that just what you net after taxes? So your net paycheck. But yes, you can deduct mortgage interest in most cases. Now they've changed it a little bit. There's some caps with it. There's only a certain amount you can deduct. So if you have, this is for people that have like 50 rental properties or just a crazy amount of other deductions that maybe they can't really take advantage of mortgage interest deduction at that point. But most people can qualify where the interest that you pay each year, you get a 1098 in the mail. That shows you the total amount that you paid, and you can use that as a deduction. It's not the principal and interest. It's not the full payment of the mortgage, but it is the interest that you paid. It'll also show you the mortgage interest if you paid mortgage insurance that can be part of that. So check with your CPA. I'm not an accountant to know whether you specifically qualify for it. There is some ways that you don't, but there's no reason that if you pay your mortgage with after-tax money, so your net check, unless I'm reading that wrong, that you can't now deduct the mortgage interest. I mean, yes, you can still, for that reason, as far as I know, there's no reason why you can't. All right, let's see what else we got here. Time, 9 minutes or so, a little over 9 minutes. Okay, next one. All right, isn't this fun? All right, next one. How do mortgage brokers find and select their funding or mortgage loan underwriting sources? So as a broker, you're going to take a client's information in. You're going to take in how they earn their income, the type of property they're buying, their down payment, their credit score, whatever it is. And you're going to know what lenders are going to take that particular client and maybe which lenders are going to offer better rates and terms or easier to work with or easier on underwriting. I mean, that's part of this whole job, is to make it as easy on you as we possibly can. Now, some of the easiest loans are also the higher rates because they get rid of the need for income documentation or 5 years worth of tax returns, or all the extra hoops to get the better rates. But I will tell you, typically the rates that have the most guidelines are usually the lenders and underwriters that have more of those hoops to jump through generally have better interest rates because they're lowering the risk of the file. Interest rates are really risk. Like, how likely are we going to have to foreclose on the property? What are some of the risk factors that determine either a higher rate or being able to say yes or no to a client? Some of those risk factors can be lower credit score, higher debt ratio, property use or type, between a primary residence, a second home, and a vacation rental. Those types of homes have different levels of risk, which means either more money down or higher interest rates to offset the ones that do go into foreclosure. So really, it's almost like an insurance in a way, that they're going to look at all the factors that determine the risk that you are and offset that with interest rate, offset that with more money down, or just say no. Some lenders will say, nope, we don't want to take that type of clientele. That's not the loans that we're looking to originate. Other lenders like, yeah, give me those loans because they can charge higher rates. So they can get better rates of return, knowing they'll take on a little more risk, a little more chance for foreclosure. So brokers will generally have a niche, or they'll have kind of clients that they gravitate towards, or their referral partners, whether it's commercial or whether it's construction or reverse mortgages or refis or purchase or government backed or conventional, or, there's all these little niches. A lot of brokers kind of start to find the niches that they like to work with. So when clients come into the door, they know which lenders to send those leads to. Plus, you got to realize most mortgage brokers, loan officers like myself, we're meeting with a lot of different clients. So we're seeing a lot of different scenarios. So when a new client comes in the door, we say, oh, hey, I had a client, very similar situation. This lender was great. Let's go ahead and send it to this lender. So part of the broker's job is to do some of the shopping for you and just know that, hey, XYZ lender is not going to take your loan because of this reason. This lender will. And maybe these 5 lenders will. And I know these guys offer the better rate, or these 5 do, and these guys offer the better rate, but they'll might say no, where this one will say yes. We'll send it to a couple lenders. So that's just part of finding the money sources, is knowing which lender will most likely take every scenario. All right, let's go to the next question. If you have any questions, comment, post below. I'll make sure I get those in other videos. If you have any questions, comments, concerns, please put those in the comments and we'll get to them on the next video. Let's see what we got here. Excuse me. Let's see. If your current lender won't give you an answer on your offer in time, can you refinance your mortgage with another lender? Yes, of course you can. If you're not liking the service of a lender, there's plenty of lenders. There's always somebody that wants your business, especially now that things have slowed down. Many mortgage companies are getting a little bit more tight on their margins. It's changed a little the first of the year here as rates have softened a little bit, which has helped. But if you're not getting the service you want, go to another lender. They're flat out. That's most of the job is a service-based thing. We're all getting the money from the same sources. We're all getting the underwriting guidelines from the same sources. It's not like an FHA loan is different with me than it is with somebody else. Now, rates and terms might differ a little bit. Investors might be different. Underwriting guidelines might be overlays. There might be differences, but it's pretty much all coming from the same source. And service is what this business is all about. Answer the darn phone, answer the email, get back to clients, follow up, answer their questions. I mean, that's really what separates me from the guy down the street. I have maybe experience is obviously part of it, being able to know what lender will do what, being able to answer your question. I mean, those are definitely part of it, the education side of it, but really it's a service-based business. So if you're not getting the service you want, go somewhere else. Even if it's not, I have so many people that sit there and say, well, I've got my loan with, the service is my loan. I'm just going to go with them because I think it's going to be easier. But realize they bought your loan most likely. Like most likely the lender that has your loan isn't the one that started it. So you don't have to use that lender on your next refi. Shop it around. Check with other lenders. Check with me. You don't have to use a particular lender. Shop your loan. Definitely shop your loan. All right. What else we got here? Excuse me. It's been a long day. I've been talking all day. That's what I do is I talk. I'm a talker. All right. Let's see. Here we go. How do lenders determine how much money to lend on a second mortgage? So a second mortgage is typically a line of credit or a mortgage after the money used to purchase a home. So it's used to typically pull out cash for debt consolidation or maybe home improvements. That's a big reason to pull out a second mortgage. And a lot of times you have, especially now, such a great rate on your first mortgage, but you have all this equity. So instead of refinancing the first to a higher rate, you can look at a small second mortgage of some kind. So with second mortgages, there's a factor known as CLTV, or combined loan to value. So what they'll do is they'll say, okay, let's say the max that we want to loan is 90% of the home's value, 85, 90% of what it's worth. Very few of them go to 100%. Most of them aren't even going to 90% anymore. Usually they're about 85. But let's say it's 90% total loan to value minus the first mortgage. That's what the second can be. So it's the 90% minus the balance of the first mortgage, and then whatever's left over, that can be the balance of the second mortgage. So it's based on guidelines, whatever the total loan to value can be. The other thing they're going to look at is debt ratio. So they're going to say, okay, well, your max debt ratio is XYZ. So your new loan amount can only go to this, and as long as it's under the combined loan to value, then that's your new loan amount. So that's kind of how they factor it. So, but a lot of times you see lines of credit, they'll just be a kind of an equal number. As long as those numbers work, it'll be 50,000, 75,000, kind of usually is a rounded off number. But it is something where it's on these 5% tiers, and there's kind of caps, and that's how they determine what they'll loan. All right, let's see what we got here. How long do you need to live in your house before you can refinance with FHA or Federal Housing Authority? Generally, the rule is 6 months to be able to use the appraised value instead of the acquisition cost. So you have to own at least 6 months. Now, there is some guidelines that kick it to 12 months, but most of the guidelines are 6 months. But I will tell you this. Even if a lot of people don't refinance from FHA to FHA unless you see a big rate reduction. There's a streamline option with FHA that's awesome. So if you say you take your loan at 8%, rates go to 6%, you can just take your old approval essentially. So the old appraisal, don't have to re-verify income and assets. They already had you approved. They just lower your rate to that lower rate. They call them FHA streamlines. But those are only common when you see kind of that big rate reduction, not the other way around, where most likely if you did an FHA loan even 6 months ago, maybe not so much now because rates have come down. Generally, you're not better to refinance back into an FHA loan again because you still have to keep the mortgage insurance. So even if you've now got miraculously 20% equity on your home, even after 6 months, I see these situations where you have a family member that kind of sells you the house, but it's worth a lot more than what they sold it for because they kind of sold it to you at a discounted rate, maybe for your inheritance, or they just said, hey, I want to just get rid of this mortgage. I need to clear this much, and then you can keep the difference. So they just set up the contract to buy it a little bit wrong. There's ways to do it better from the beginning, but that's what I'll see is I'll see people that inherit a home or get a loan or have to pay off a spouse from a divorce or something like that. And then, but they know they have a lot more equity than really what they bought the home for, but they still have to wait that waiting period before you can go off the appraised value. But once you can go off appraised value, you really don't need generally FHA loans. Now you can maybe get rid of the mortgage insurance. Maybe you can get rid of the rate might be a little bit different at the time. So there's better loans once you can get out of FHA. I mean, FHA is much more common to purchase the home than really to refinance into an FHA loan. Now there's exceptions, of course. Do you want to work on your credit? So the higher you can get your credit during those 6 months will get you into a better loan than maybe an FHA, because FHA's mortgage insurance is the same whether you're a 620 credit score or a 750 credit score. But obviously a 750 credit score on conventional loans has cheaper mortgage insurance and even options to buy it out completely where you don't even need it every month. So that's part of working with a client to be able to figure out what they want to do. But I've seen a lot of questions on here about refinancing into an FHA when really FHA is more purchase. If you do it right, you should be able to refinance it into a conventional loan, honestly. How are we doing on time? We're almost at 20 minutes. Let's see if we can do one more here. I saw this question. I think I already answered in one other video, but let's just do it kind of one more time here. It says, do you need W-2s to get an FHA loan? No. So you can be self-employed to do an FHA loan. You don't have to be a wage earner, W-2, hourly salary. You can be self-employed. What most people that are self-employed, though, we go off your taxable income. So if you made, say, 150,000 but wrote off 140 of it, then your taxable income is only 10 grand. So then you may not be able to qualify for the loan. Not because you're self-employed, just because you write off all the income. You have more deductions as self-employed and usually have more expenses. Now you're paying for your truck and you're paying for employees, possibly you're paying for other things that come out of your income. So then it also comes out of your qualifying income for a loan. So generally, That's where you run into an issue with self-employed borrower, especially this time of the year. We're first of 2023 here. I review a lot of tax returns for people before they file, saying, okay, based on this return, this is how much you qualify for. If you're trying to qualify for more, you may have to claim less expenses and just have to eat it a little bit as far as what you pay Uncle Sam. But maybe you got to pay Uncle Sam $2,000 or $3,000 more, but you get an interest rate that's way better or less money down on the house. So pay a little more than Uncle Sam, but over the long run, you'll have maybe a better mortgage loan, depending on how close the numbers are. Now, if you're writing off so much where you have to claim all of it to qualify, then that's where it's going to be a lot harder. So there's other programs that don't require the tax returns, but they're not going to be the better interest rates. They're not going to be less money down. So the more you can go that route, the better the rates and terms. But it's always a balance. Is it better to pay more in interest, or is it better to pay more to Uncle Sam? Either way, somebody's getting the money. So that's part of the job, is to figure out which is the better way to get it done. All right, we are at just over 20 minutes. I like to keep these to 20 minutes. So appreciate your time watching these. Please like, comment, share, subscribe to the channel. I do other videos on the channel. We do some how-tos. I've got a couple videos planned out that'll be coming out in the next couple days. And then obviously the Q&As I have a lot of fun with as well. But love to earn your business. If you're doing loans in Utah or Nevada, that's where I'm licensed. You can go to my website here on the bottom of the screen, ryanbolton.com. You can apply online right there. There's a mobile app that you can download. We offer lines of credit. So if you're looking to do a line of credit on your home, or if you just want to schedule a call, even if you don't need a loan in those states, I'm here to help. So if you have any questions, I'm more than happy to answer. No cost, no obligation. That's just what I do. So I love talking about this stuff. So if you need help with a mortgage, I'd love to be there for you, and obviously love to earn your business. So thanks for your time, and see you next time.